So a beautiful Sunday morning, another Sunday morning on the Bet Out of Debt show.
Yes.
And Patrick, we've had a pretty successful week. One, being here, going over to Summerlin, looking at real estate. We shot some video, as well as we did a trade, both of us, that you set up on Friday that you had previously did on Wednesday, and we made some good money.
Yes, we did.
So let's get into it with our audience. Let's go right into the nitty gritty and just kind of share the trade of the week, the trade we're planning to do tomorrow as well, and how we've made over $1,000 in the last couple of days, just short trades. For me, I made over $700 in about an hour and 15 minutes. You made a little more over the last couple of days. So if you would like, Patrick, let's get into it and share your desktop. Let's show them what we're looking at.
Okay. So I'm just going to share my screen right quick. So first of all, I just want to welcome you all back to the show, shooting from fabulous Las Vegas. Sitting here at the glorious Wynn Hotel. It's always a great stay. Highly recommend. If you want a little bit of finer dining in and finer hotel stays, it's got all the amenities you would need, fine shopping, close to Strip, and so on and so forth. But anyways, what we're looking at right here is the S&P 500 index. And again, it's a market-weighted index of 500 of the most highly capitalized stocks on the U.S. market exchanges. And it's also a benchmark. The good thing about the S&P 500 options is that there's a very active market in them. So the bid and the ask spreads are usually pretty tight, usually within 5 cents of each other. And it's very easy to get in and get out of the trade. Right now, I am looking at the chart of the S&P 500. It's a 6-month chart, daily chart. I'm using the Bollinger Band to analyze the trades and to see where I should place the trade. Right here, you can see that the S&P 500 index is getting closer to the top end of the Bollinger Band, even though it keeps making an all-time high day after day because of the good economic news that's coming out. However, the long run, obviously, the S&P 500 is always going to win. It's always going to outperform any savings accounts, the Dow 30, and any active mutual fund, hedge fund manager. And I've discussed this in previous videos. However, I think over the short term, there could be, a little bit of give back of some of these gains in the S&P 500. And here, the moving average MACD indicator, which is widely followed, seems to be peaking here, at where the S&P 500 has peaked at around 4193, 49, just under 4200. As the S&P 500 has gone towards a new all-time high of about just under 4280, 4290, I think it recently closed at 4280 and change. The MACD indicator has actually declined considerably. And so that just suggests that there's possible weakness in the short run. And here, I'm showing the MACD indicator again on this chart to show that the convergence is still in effect. However, I think the S&P 500 index could actually come and meet this resistance here. So we're looking at around maybe 20, 30 point
all right. So Patrick, before we go into the
yes,
before we go into the nitty gritty of the bear call spread, I just want to make sure we gave a lot of information very quickly.
yes.
So I want to just make sure, I just really want to ensure the audience followed what we just talked about.
Okay.
Because we know we have some people who are familiar with options and familiar with trading.
Yes.
And there are others who a lot of that may have gone over their head based on where they are in the game. And we are a channel for beginners, right?
Yes, we are.
So can we go back to bar chart where you were showing the Bollinger Bands?
Yes. And this is it.
I am not seeing the Bollinger Bands.
You're not seeing this here.
Yeah, I'm seeing it. I'm seeing it here. Okay. So just being at the top of the Bollinger Band there, right?
Yes.
So being at the second deviation high,
yes,
for the S&P 500,
yes,
that is saying that any trade we put on above the top of that Bollinger Band, we have a 95% chance of winning that trade because the stop price is going to be, there's a 95% chance the stop price is going to be in between those lines, below that top Bollinger Band and to the bottom of that Bollinger Band. So we're using probabilities in our favor here, looking at the S&P 500 being at the top of that Bollinger Band, knowing that we can place a trade slightly above that Bollinger Band. We can win that trade because the stop price is not going to go there. The option will expire worthless. And in it expiring worthless, we would keep the premium that we collected by selling that option. I hope that makes sense. And I hope I didn't oversimplify that. Did that make sense, Patrick?
It does. We'd have to get into the mechanics of how it's going to expire worthless, but for the most part, that does make sense.
Okay. Yeah. And then the other thing we didn't explain, which we're about to explain, is we're going to do a trade within the same day. So this is not going to be a typical trade that we would do. This is going to be more of a day trade, right, Super? Right, Patrick?
It's going to be the day trade. Exactly. So you don't want to hold trade or choose an expiry date beyond the day you enter that trade.
So this is a little different for us because typically we talk about swing trades. And a swing trade is when you go more than a day. But today, what we did on Wednesday and what we did on Friday was an actual day trade. So we got in an hour or a few hours before the market closed based on where the S&P was in line with the Bollinger Band. We decided to get in above the Bollinger Band, sell an option, collect premium, let it expire worthless, the option, and kept the premium. But it is a day trade. So a little more risky of a strategy, but we're using probabilities in our favor. We've been winning, so we wanted to share. That's all I'm going to say, Patrick. Continue, please.
Okay, so now let's go to the mechanics of the trade. So I'm going to bring up Thinkorswim. And can you see my screen?
I got a slight delay here, Patrick, but I'm working with it.
Okay.
You know, being here in this hotel in Las Vegas, you're in the beautiful Wynn, I'm in the MGM. So we are working with the internet in a hotel situation here, but yeah. I'm not seeing it so far.
Okay, let me stop sharing my screen and then maybe I'll reshare it. Can you see it now?
I'm waiting. Maybe it's up in the community. I am still not seeing. Yeah, it is up now. Yeah, I can see it.
Yeah, okay. So it's just a few technical difficulties, but ultimately we are able to show you what we want to share. So right now I'm looking at a trade that I saved. It's essentially a credit spread. So those who don't understand what a credit spread is, what you're doing is, in this case, you're selling the a more expensive, closer to the money, or closer to the price of the index, because these are more expensive options, and to offset that, you are buying less expensive options.
Now, Patrick, just to interrupt for a second, sorry. Yeah, I want to make sure that they understand that the option strike price that we are picking is above the Bollinger Band. So
okay,
please make that point.
And we are, sorry. Yes. Yeah, so essentially, so we're buying a less expensive call above the Bollinger Band. Both of these are going to be above the Bollinger Band, but the one that you're selling might be closer to the Bollinger Band because it's more premium than the one that you're buying, which is farther away from the Bollinger Band. Hence, it's a cheaper option. Hence, you're going to be collecting premium, and as a result, it's called a credit spread, i.e., it's crediting your account. So here, I am choosing a strike price of $42.95 as the sell call, and the offset call is 4,300. And let me go back to the chart. So I'll stop sharing here again, and let me get back to the chart.
Yeah, so you're going to show that Bollinger Band. And Patrick, I like what you did on this trade. I actually followed this trade and made $700. It was an easy $700 because we picked $10. It was either $10 or $15 above the Bollinger Band, because the Bollinger Band showed like 42.80, and we chose like a 42.95 strike for some safety, or was it a 42.90? It was something like that. Yeah, but it gave us a margin of safety so that in case there was an intrusion, we were still safe for the option to expire worthless.
Yes. So essentially, you're playing the odds is what we're doing. So right now, the top end of the Bollinger Band is roughly 42.80. I'll just say 42.81, 42.82. The option trade that we're looking at is roughly 42.95. So if the market were to stay at around 42.80, what you want to do first, before you're entering that specific trade, is you want to see how the market performs in the morning. If there should be some kind of catalyst that maybe sends the market higher, for example, maybe let's say that in the first few hours of trading, the market goes up by maybe 10 or 20 S&P points, then you would have to adjust the trade accordingly in case the market continues to surge, or you're putting the trade a little bit too close to where the market is. So essentially, what you want to do is to ensure that there's a big enough cushion between where the market is and where you want to place a trade. Hence, this is why you want to call this a day trade. This is not a trade that you want to carry overnight, because the S&P 500 is affected by economic news that could sway the market in any way. And what I like to do is I like to follow the economic news that's upcoming. Like, for example, let's go economic calendar. Use the U.S. economic calendar. So for Monday, Monday seems to be kind of uneventful. You'll have a few Fed presidents speak about the market. Not generally market shattering stuff that's out there that could really cause the market to sway in one way or the other. However, on Wednesday, the market indicators for producer prices, which is a gauge of inflation, that can move the market. And you don't want to place your trade before 9:45 Eastern Standard Time, because that's going to move the market in one way or the other. So you just want to, let the economic news have its impact, and then see how the market does, and then you place a trade accordingly.
So, Patrick, we're looking in the past here. Let's look at today is June 27th.
Yes.
So what is the market outlook there coming on Monday?
So
June 8th, June 28th. Sorry.
Okay, sorry. Yeah, so I made a mistake. Yeah, I thought that was the upcoming week. So Monday, June 28th. Yes. So you have the New York Fed president speaking, and it's not a market moving event. It's not like you have the Federal Reserve Chief Jerome Powell talking about interest rate policy, how he sees the market, how he sees in interest rates, and that determines his monetary policy, which is always market impacting. So it's going to be on the economic calendar for Monday, pretty quiet. So hence, I don't predict that the market should move, violently in any one direction. So it could be a good day to place a trade.
Yeah. So from economic report situation, we feel like the volatility will not come from there. It may come from something else, but certainly will not come from this. Hence, it may be a good day to place this trade that we placed on Friday and you placed on Wednesday.
Yes. If any volatility should come about, it would come through maybe an earnings report on a key stock or any key news considering a stock. But the good thing is about the S&P 500, you're talking about 500 stocks. So even if it's a fairly large stock, but it could be Amazon, or it could be Google, or any such large company, Goldman Sachs, it should have a minimum impact on the S&P 500. It may affect it down more because you're only talking about 30 stocks there, and that being a price-weighted index. But a market-weighted index of 500 stocks, that shouldn't impact the market too much. Any news from the from any of the S&P 500 components.
So Patrick, I really liked how I made $700 on Friday in an hour and 15 minutes doing this bear call spread that we're about to discuss in detail. The S&P 500 XPS, was it XPX or the XPY?
It's the XPX.
The XPX was at, okay, the XPX was at 4280 on the high, on the second deviation high of the Bollinger Band. I know on Friday we chose the 4290 to put our short strikes. That's where we sold our calls. And then we did our long strike where we bought against it $5 above that at the 42.95.
Yeah, it was up here.
So we did a 42.90, 42.95 bear call spread to say, and what we essentially were saying was, we do not believe the S&P 500 is going to get to 42.90. Some people out there in option land said, we think the S&P 500 is going to go against probability. And even though there's a 5% chance, and it's even a less than 5% chance to get up there, it's more like a 3% chance. They felt like the S&P 500 could get to 42.90. We said, no way. We put that trade on. I put that trade on an hour before the market closed and collected 700. And it worked. So what is the trade we're going to do on Monday? It was 42.90, 42.95 on Friday. On Monday, are we looking to do 42.90, 42.95 again? Or are we going to do a little slightly higher at maybe 42.95, 4,300? So
okay, let me share that screen,
because I'm good with collecting another $500 while I'm in Vegas in a few hours, or I'm good with that.
So here it is. So we're looking at placing the trade at 42.95 strike. So it's going to be even higher because the S&P closed up from 42. It closed up at 42.80 from 42.70. So we're going to place it around maybe 42.90 if market conditions are around 42.80. If it moves up, obviously you're going to adjust the trade if the market moves up before the end of the day. Again, this is a day trade.
So,
but however,
based on what you're showing here, Patrick, that's $1,000. That $1 price with 10 contracts. So you would collect $1,000 for that trade.
Exactly. You collect $1,000 for that trade and risk 4,000. So you're talking about 25% return.
So you're talking about a quick 25% return in one day. So, oh man, I'll take that trade. I'll take that trade depending on where the market opens and how the S&P 500 is behaving.
Yes.
On Monday.
Yes.
And if the SPX is below that Bollinger Band and the volatility is not crazy, I would absolutely sell that 42.95 and buy the 4,300 against it, collect $1,000 and wait for it to expire worthless that day and walk away like a bandit with that grand. I could use that $1,000, Patrick.
However, it might, depending upon what the option premiums are on Monday. If the option premiums are, if there's lack of volatility, the option premiums might shrink a little bit, and you might not collect quite $1,000, but it would be, a few $100, I think, for just an hour and a half worth of work. I mean, it's pretty good.
But Patrick, even if right now it's showing a price of $1, right? But let's say the price is 50 cents.
Yes.
If we were to sell 10 and buy 10 against it with 50 cents, that's $500 in a day.
Exactly.
And then we got a 97% chance of keeping $500.
Yes.
I mean, I'm going to take a chance. I'm going to take that chance. I mean, I will, not all. and we're not telling all. We're just showing people what we're doing, the community. If you want a quick 300, 500 in your pocket and you're willing to take that risk and you understand what we're doing. But that's what we're doing. That's the point.
Yes, yes. So you're using the odds in your favor as much as possible. That's what this equates to, what I'm showing right here.
All right. All right, Patrick. Well, look, I hope that we have favorable market conditions on Monday. I know I'm going to be glued in front of my screen like we were glued in front of our screen here in Las Vegas on Friday. And I think you could stop sharing. I think that shows the point. And did you, Patrick, did you kind of circle where we were so that the audience on the Thinkorswim platform could see exactly where the trade was? Because some people may have been confused by that whole Thinkorswim.
Okay.
So maybe you can circle it with the cursor because, I zoom right in because I'm very familiar with Thinkorswim, but others may not. They may be using E-Trade. They may be using Robinhood. So just kind of showing exactly where it may be helpful before we sign off.
Okay, sure. So let me go for charts. Okay, let me kill this order. Just kill that right now. So let me zoom in. So here's the 4280.
And this really works because of where the S's and Sam, P's and Paul, X's and X-ray, the S&P 500 is in relationship to the Bollinger Band. So that's why this is working. And what Patrick talked about earlier with the MACD showing a divergence, meaning that the S&P 500 is moving closer to the second deviation high, which is the top line of the Bollinger Band. But the MACD is in fact saying it should be falling because there's a divergence. So it's kind of a fake move to the top of the Bollinger Band. So that's why we feel somewhat comfortable with setting a strike above it and collecting premium.
Yes.
Because we do not believe that the S&P 500 is going to be able to make it to the premium above that top of the Bollinger Band. So, but go ahead, Patrick.
So essentially, we're talking about, so the market had a high of 4286, but it closed at 4280. So it's still up pretty handsomely. It's up about 14 points on the S&P, which is a good gain for the day, or a decent gain for the day. Right now, if the current conditions.
Patrick, I'm not seeing your screen. Are you sharing your screen? Sorry.
I believe I am. Let me see.
I'm not seeing it.
Okay. Let me see. I'll make sure I am sharing the screen. All right. Can you see it now?
I have a slight delay, so let me see.
Okay. I might not have been sharing the screen. If I wasn't, I apologize.
Patrick, while you're sharing your screen, you made a very good point. And that's another good point, which given us the confidence to do this day trade, which we typically do not do. And that is the S&P 500 is at all-time highs. Mm-hmm. So when in the indices, stock, anything gets at all-time highs, at some point it needs to take a breath and take a breather. So with it hitting all-time highs, we feel like we're catching it also, whereas it needs to take a breather at some point. So that gives us even more confidence going above doing a bear call spread. And then for those who want to learn more about bear call spreads, you can just go YouTube it. And there's so many YouTube videos explaining the strategy. So we're not going to take the time to, go any further than just showing the actual trade. Okay, Patrick. So kind of circle and show the actual trade we're doing here, like right in the specific areas.
So let me see. Let me see if I can do a circle.
And you are sharing, so I can actually see now.
All right. So I've forgotten how to do a circle. Give me 1 second. I know it's in drawing somehow. Let me move this over.
That's the technical Patrick with the drawing tool. Very nice, Patrick.
So that's an ellipsis right here, oval.
Right.
And then let me zoom in a little bit. Let me zoom in a little bit more. I can barely see it myself. Oh, that's too much. Okay, so draw, circle. Okay, give me 1 second. Let me zoom in a little bit more. I can barely see it.
Patrick, you're doing a lot of zooming there, my friend.
Yeah.
It doesn't seem to be working. So you're doing that. And then let's look at the actual, let's go into the save center, the open entry and save center.
Okay, let me have it. Sorry. Let me back out. Yeah. Yeah, I don't know.
That's actually save order. I said center is actually.
So you want to take a
entry.
You want to take a close
save. Go ahead.
Yeah.
Go ahead.
So you want to do this right here, right? Is that what you wanted to take a look at? So that's the 1,000 you might collect versus 4,000 that you put up.
Don't send and confirm. Do not do that.
Of course not. Well, it'll get rejected. That would get rejected
I'm
anyway.
just saying, look in this area. So just kind of explain the vertical sell by, the -10, 10, and what we're looking at price.
Okay. Okay. So right now we're looking at 10 contracts of selling, and that's at the 42.95 level. That's the more expensive option that you're selling, and it's a call. So when you sell a call, you're making a bearish prediction that the market's going to either stay the same or go lower. So it's going to be just slightly above the Bollinger Band here. So this is the Bollinger Band, the top end of the Bollinger Band. So it's going to be about 10 points above 10 to 15 points above the Bollinger Band. So it's around, I apologize if the writing's a little bit small, but it's roughly 42.95, and the Bollinger Band is reading at 42.80. So that's giving it a 15-point leeway. Now, when the positive means that you're buying 10 options of the call, which is farther away from the Bollinger Band, so hence it'll be a little bit cheaper. So that's going to be placed at 4,300. So that's roughly 5 S&P points between the two. In essence, you're collecting about $8,000 worth of premium. So you're going to have 10 contracts that you're buying, that you're selling, and then 10 contracts that you're selling of the lesser expensive option. And that's going to be the mechanics of the trade. And you're doing that not at the beginning of the day, but you want to see how the day progresses. And then as the market kind of settles out in a range, maybe midday or towards the end of the day, you may want to place a trade then.
All right, Patrick, let's look at the confirm and send and look at how much buying power this uses, because when we're talking like doing naked puts or naked calls, you're talking buying power. This significantly reduces your buying power by doing a spread. So will you hit send and confirm and send, just to see how much buying power it takes to put on this trade?
So the buying power right here, the buying power effect is $4,013.
All right. Could you repeat that buying power again, Patrick? Because I have a slight delay.
The buying power is $4,013, because you have to pay a little bit more for the commission. So you're going to be paying about roughly.
But that's the commission. That's the
Yes.
commission to put on the trade, right?
Yeah. So you're not going to grow. You're not going to net 1,000. As if you're.
Why am I not seeing that on the screen, Patrick?
Okay.
I don't understand why I'm not seeing that.
Because I am sharing the screen. So
yeah, it's just a hotel connection. But here's the thing. The point I wanted us to make is you need to have at least $4,000 in your account to be able to put on this trade. And here's the beautiful thing about spreads, what makes it such a great vehicle, a great tool to use when trading options. We're looking at an index that's like $4,280 just to buy one share. We're trading 10 contracts on the top and bottom side, like we're selling and buying. 10 of these 4,280, 4,290, 4,295. But in the end of the day, we only need $4,000 of buying power to put on the trade to make 1,000. That's beautiful. If we were not doing a spread, this would cost hundreds of thousands of dollars to put on this trade.
Exactly.
But the fact that we're doing a spread, meaning we're selling and then we buying against it, it only costs $4,000 to put on the trade. Meaning, and when I say cost, that's kind of not really what it costs. That's what you're putting at risk if the trade goes against you. So you actually get the money immediately once the trade goes through. But if the trade did not go in your favor, you got $4,000 at risk, but you got a 97% chance of winning the trade.
Yes.
So that was it. But Patrick, that's what I kind of wanted to make sure we made that point before we signed off. Anything you want to say in closing? I think we can close this out.
Okay, so I'll just kind of do a recap of why I think this is a good trade. Number one, it's at the top end of the Bollinger Band. Number two, you have divergence. Number three, there's a lot of liquidity in this trade. And I'd even add in a fourth trade. If upon expiry, there's no physical asset that gets assigned or taken away. It's essentially the difference between the two strike prices and where you are with the market, and it's cash settlement.
Patrick, can you please stop sharing so that we can see one another?
Yes.
Thank you.
So that's essentially it.
All right, Patrick. So I think that's it, buddy.
Okay.
I think that's kind of what we wanted to share today.
Yes.
And, we have another day here in Las Vegas to kind of do our thing, looking at real estate and catching up. We haven't seen each other in a little bit. So
yes,
rather than make the show longer than what it has to be,
yes,
I think we went into a lot of detail on this trade.
Yes.
We're certainly on Monday about to put this trade on again. And next Sunday, we'll kind of report out on how it goes over the course of the week.
Exactly.
All right, guys. Well, this has been another edition of the Bet Out of Debt Show. We call it the Bet Out of Debt Show because when you place a bet, when you place a trade, it's called placing a bet. And hopefully it's a winning one that will keep you out of debt. So as always, keep investing and take care.